The strangest bailout in America is the one that never arrives with a press conference. No one walks onto a stage and announces that your mortgage balance has been forgiven. No one logs into your loan portal and types a zero. No one calls your house and says, "Congratulations, we have decided to make your debt disappear." And yet, if you understand how the system actually works, you will see that a piece of your mortgage can absolutely be erased over time. Not erased in nominal dollars, erased in real weight. That distinction is where almost all the money is. I want to start with the part that most people get wrong. They think the story is about one man, one appointment, one meeting, one new policy. One exact date when the Federal Reserve supposedly flips a switch and starts rescuing debtors. I do not think about it that way. I have been around long enough to know that the names change faster than the mechanism. The mechanism is older than any Fed chair. When a country builds more debt than it can comfortably outgrow, and when paying that debt back honestly in stronger dollars becomes politically painful, the temptation is always the same. You do not have to default. You do not have to confess failure. You do not have to send bondholders a letter saying you will not pay. You simply repay them in dollars that buy less. That is the old trick. It is not elegant. It is not moral philosophy. It is arithmetic. If I borrow 1,000 strong dollars from you today and hand you back 1,000 weaker dollars 10 years from now, the contract was honored in form and violated in substance. The number stayed whole. The purchasing power did not. Now widen that thought from one private loan to an entire country. The federal government carries a debt load so large that servicing it has become one of the most important facts in the whole financial system. Every mature obligation has to be refinanced into the interest rate environment of the day. Every rise in rates makes the carrying cost heavier. Every year of stubborn deficits adds another layer. You do not need a secret meeting to understand where the pressure builds. The math tells you long before the speeches do. And whenever a government sits under that kind of debt, it begins to prefer one type of citizen over another. It begins to prefer the debtor over the saver. Not because it says so out loud, because the system only gets easier to manage when debt is lightened in real terms, and when cash earns less than inflation for long enough that the burden quietly shifts. That is the important sentence. If inflation runs above what safe cash earns, then the saver is the one financing the adjustment. The saver thinks he is standing still. He is not. He is walking backward very slowly while feeling perfectly calm. That is why I want you to think of the dollar the same way you would think of a battery. The size of the battery can stay the same, the label on the battery can stay the same, but the charge inside can leak away. That is what inflation does to cash. It does not make the bill disappear. It makes the bill weaker. And debt is simply somebody else's future dollars. So when the charge drains out of the dollar, the charge drains out of the debt too. If you owe the bank $300,000 on a 30-year fixed mortgage, what you really owe is 300,000 future dollars. If those future dollars become less powerful while your payment stays fixed, then the real burden of your mortgage shrinks even when the nominal balance declines on the original schedule. This is what confuses people. They think in nominal payment, I think in real burden. Those are not the same thing. A fixed payment in an inflating world is a different animal from a floating payment in an inflating world. If your mortgage resets upward every time the cost of money rises, you do not own a gift. You own exposure. If your mortgage is fixed at a low rate for decades, then you are holding something much more interesting. You are holding a contract that does not move while the world around it does. That can become extremely valuable. I saw this lesson written in giant letters in the history of the post-war period after World War II. The United States emerged with debt levels that looked suffocating. The country did not solve that problem with a pure act of fiscal sainthood. It did not simply sit down, tighten its belt with monk-like discipline, and pay everything back in stronger and stronger money. A great deal of the adjustment came through growth, yes, but also through a world in which inflation periodically ran hot and safe returns did not fully compensate savers for that loss in purchasing power. That combination matters. When inflation is running and safe savings instruments lag behind it, debt melts in real terms. The person holding cash feels prudent. The person holding fixed debt on a real asset often gets richer. And that is the part that almost nobody wants to say plainly because it offends the old moral language of personal finance. Many people were taught a rule so simple that it became sacred. Get debt free as fast as possible. Pay off the house early. Sleep well. Owe nobody anything. There is wisdom in that rule for many kinds of debt. Credit card debt deserves aggression. Car debt deserves suspicion. Variable rate debt deserves respect. Debt taken on to finance vanity usually deserves burial. But a low fixed mortgage on a durable asset is not the same species as revolving consumer debt. Not remotely. I have watched families spend 30 years fearing the wrong debt while ignoring the real enemy, which was silent monetary dilution chewing through their cash. They were so proud of sending extra principal to a bank charging them 3% that they missed what their savings account paying almost nothing was doing to them every day. They believed they were buying certainty. In reality, they were surrendering optionality. Let me show you why. Suppose you have a fixed mortgage at 3.25%. Suppose the country spends years in a world where inflation averages something close to that or higher. Suppose your wages, business revenue, rental income, or general nominal cash flows rise over time. Even imperfectly, because the price level across the whole economy does not stay still. Your mortgage payment does not care. It sits there like an old photograph, same contract, same schedule, same nominal number, but the dollars you use to meet that payment are different dollars now. They may be earned in a more inflated economy, priced in a more inflated labor market, or collected from tenants paying rents set in a more inflated housing market. The house stays real, the debt stays nominal. That spread is the gift. The borrower who understands this does not rush to kill low rate fixed debt just because a radio host told him debt is always evil. He asks a more intelligent question, compared with a savings account that leaks purchasing power, compared with paying down a contract that is already getting easier in real terms, compared with giving up liquidity that could be used to survive, invest, or negotiate from strength during the next dislocation. That is the question, compared with what? I have always liked looking at decisions that way because it strips away the false virtue of blanket rules. The world is not improved by slogans. It is improved by comparison. Now let us talk about the losing side of this arrangement, because every hidden transfer has a payer. If the system is reducing the real burden of debt, someone is eating that reduction. That someone is usually the person who keeps large idle cash balances in underpaying accounts and congratulates himself for being careful. He sees $100,000 on a statement and thinks he has preserved $100,000 of economic power. He has preserved the label, not the charge. If inflation runs at 3 or 4% and his cash earns a fraction of that, then his balance is not standing still. It is being quietly harvested. The bank can lend at one rate and pay him another. The spread belongs to the institution. The loss of purchasing power belongs to him. This is why I say the most expensive thing in finance is often not panic. It is passivity disguised as prudence. A grandmother with money idling in a giant bank at a near zero rate is not keeping herself safe. She is allowing the battery to drain in the least visible way possible. She does not wake up to a crash. She wakes up 10 years later to a realization that her so-called safe money buys much less of life than she assumed it would. She did not feel robbed because nobody grabbed the statement out of her hand. The theft was monetary, not theatrical. And that is precisely why it works. The system depends on millions of decent people confusing nominal safety with real safety. Now, before you misunderstand me, I am not saying every mortgage should be preserved forever under all conditions. That would be another foolish slogan. A low-rate fixed mortgage can be a splendid asset under the right conditions, but only if you behave like an owner of capital instead of a consumer who just found an excuse to borrow more. There are clear exceptions. If your mortgage rate is high, this discussion changes. If your debt is floating, this discussion changes. If the payment strains your life, your sleep, or your emergency margin, this discussion changes. If keeping the mortgage causes you to leave toxic balances on credit cards, this discussion changes. If you lack cash reserves and one bad quarter could force a bad liquidation, this discussion changes. And if you are the kind of person who interprets any financial slack as permission to inflate your lifestyle, then preserving cheap debt may simply become a gateway to self-destruction. The math can be right and the behavior can still be wrong. I have seen that many times. The contract helps the disciplined. It can ruin the impulsive. So I do not want you to leave with a slogan. I want you to leave with a framework. The first part of the framework is to know whether your mortgage is actually cheap in real terms. Pull the note, look at the rate, look at whether it is fixed, look at the remaining term, look at the payment as a share of your household income. Do not talk about debt in the abstract. Talk about this debt. A 2.75% fixed mortgage with 24 years left is a different universe from a 7.4% adjustable loan that can reset into a tighter household budget. The second part is to compare that mortgage honestly against the alternatives for your cash. Not the fantasy alternatives, the real ones. If every extra dollar of principal you send earns you a guaranteed return equal to the mortgage rate. That sounds attractive until you remember what else that dollar could do. It could sit in a better cash vehicle earning a competitive yield. It could fortify your emergency reserve. It could be used to buy productive assets during a sell-off. It could keep you from taking destructive debt later. It could sit ready while inflation keeps making your old fixed mortgage lighter. Liquidity has value, optionality has value. People underprice those two things because they are hard to brag about at dinner. But in finance, bragging value and survival value are not the same. The third part is to separate consumption from balance sheet improvement. This is where most people fail. They hear that low-rate debt can be valuable, and they immediately convert that insight into a license to behave badly. They pull equity to renovate kitchens that were already functional. They buy trucks that depreciate. They call that strategy. It is not strategy. It is self-deception wearing a tie. If you ever use home equity, you should know exactly why. You should know where the cash is going. You should know how the return is expected to exceed the cost and by what margin. You should know the downside. You should know what happens if rents soften, if your business slows, if rates stay higher than expected, if your timing is wrong. You should know before you borrow, not after. Otherwise, you are not managing capital. You are improvising with leverage. And improvisation with leverage is one of the fastest ways to turn a smart macro thesis into a personal disaster. Now let me tell you the psychological part of this story, because people miss it all the time. The appeal of paying off a mortgage early is emotional. It feels clean, it feels complete, it feels like moral progress. You can stand in your kitchen and say, "Nobody owns this house but me." I respect that feeling. I do. Peace of mind is not nonsense. But peace of mind is expensive when purchased without arithmetic. I would rather have a fortress balance sheet, abundant liquidity, a properly managed low-fixed mortgage, and the ability to redirect capital intelligently than a paid-off house and a weak cash position in a world that is busy repricing everything. That is my temperament. It may not be yours. But if you choose the paid-off house, I want it to be a conscious trade, not an inherited slogan. I want you to know what you are giving up. You are giving up the chance to let inflation and time work against your lender instead of against you. You are giving up optionality. You are giving up a contract that may be more favorable than any new debt you will ever see again. And in a world where governments are more likely to reduce debt burdens indirectly than to tolerate full real repayment pain, that matters a great deal. This is why I say your low-fixed mortgage can become one of your best assets. Not because debt is glamorous, because the terms matter. Terms always matter. I learned that decades ago. A wonderful asset financed badly can become a burden. A decent asset financed brilliantly can become a compounding machine. Most amateurs obsess over price and ignore terms. Professionals study terms because terms decide who has to move first when the weather changes. A 30-year fixed mortgage at a low rate means the bank is the one stuck with the old contract while the economic climate shifts around both of you. That asymmetry is precious. Do not waste it casually. Now let us translate all of this into practical action. First, stop pretending that your balance sheet is one bucket. It is not. You have assets that inflate with the world and liabilities that may or may not. You have cash that may be quietly bleeding and debt that may be quietly shrinking in real terms. Write it all down. Your mortgage rate, your remaining balance, your monthly payment, your cash balances and their actual yield, your other debts and their rates, your housing equity, your emergency reserve. You cannot manage what you have not made visible. Second, if you are holding serious cash at a lazy bank, move it, not into nonsense, into instruments that at least respect your existence. Competitive high-yield cash accounts, short treasury vehicles, treasury bills, money funds. You actually understand structures that give you a fighting chance of keeping up instead of surrendering immediately. No, that does not solve inflation forever, but it reduces needless leakage. A lot of people think financial improvement requires one grand heroic move. Usually it begins with refusing stupid leakage. Third, if your mortgage rate is low and fixed, stop sending emotional extra principal unless you have already handled the true priorities. Those priorities are simple. High-interest debt must die first. Emergency reserves must exist. Insurance gaps must be closed. Retirement structures must be funded rationally then. And only then do you decide whether the emotional return of prepaying the mortgage exceeds the real financial value of preserving the contract. You may still choose prepayment, but at least you will choose it with your eyes open. Fourth, if you have meaningful home equity and no plan for it, study it before the world forces. The lesson on you: do not worship home equity as a magical treasure and do not rate it as a toy chest. Treat it as stored optionality. There are seasons when you leave it sleeping. There are seasons when you use it to restructure your life more intelligently. The key is that you decide before the pressure arrives. The middle class usually makes its worst debt decisions in a hurry. I prefer preparation to hurry. Fifth, understand who the real enemy is. It is not your old fixed mortgage. It is not the nominal debt number. It is the slow confiscation of purchasing power from people who mistake stillness for safety. Inflation is especially cruel because it punishes the person who thinks he is behaving. It punishes the worker who saved diligently in the wrong place. It punishes the retiree who trusted the statement more than the math. It punishes the conservative family that hated debt so much. They never noticed cash was the thing being attacked. That is why so much bad advice survives. It flatters people morally while injuring them financially. I have no interest in flattering you. I would rather help you. And helping you here means telling you something that many people never hear clearly enough. You do not win this era by obeying every old rule. You win it by understanding the mechanism the rules were built for and then asking whether that world still exists. The world that produced pay off all debt immediately was not this world. The world that produced just leave big cash at the local bank was not this world. The world that produced government debt problems or somebody else's issue was not this world. This world is one where large debt burdens create policy incentives. This world is one where nominal claims and real purchasing power are separating all the time. This world is one where a disciplined borrower with the right fixed contract can quietly do much better than a fearful saver following a 1980s script. That is the truth. And truth, when it first arrives, often feels like disobedience. I would like to leave you with one image. Imagine two households. The first household is proud, cautious, obedient. It has a low-rate fixed mortgage, but it sends every spare dollar to the lender as fast as possible. It leaves its remaining cash in sleepy accounts because that feels safe. It celebrates the shrinking mortgage balance every month while inflation quietly shrinks the real value of its idle reserves. The second household studies the mechanism. It kills expensive debt, preserves liquidity, moves cash to better terrain, keeps its low-rate fixed mortgage alive, and lets time and inflation reduce the real burden for it. It understands that not all liabilities deserve the same hatred, and not all assets deserve the same trust. 10 years later, the first household will feel virtuous. The second household may actually be free. I know which outcome interests me. Your job is not to win an argument with a radio host. Your job is to position your life on the right side of arithmetic. If the country chooses the old path of lightening debt through weaker dollars, then you want to own things that can live in that world. You want productive assets. You want liquidity that is not asleep. You want fixed obligations that do not rise with the storm, and above all, you want the discipline to stop confusing old slogans with present truth. That is how a government quietly lightens its own debt, and that is how, if you are paying attention, the same current can quietly lighten yours.